Welcome, everybody. Thanks for being with us for our quarterly economic and market update. Brian Regan is joining me. He's our senior portfolio manager. I'm Chris Boyd, and happy to have you all joining us for the update. Brian's going to run through a variety of things today, including the idea of what are the risks and opportunities that we are facing, and try to give you some insights as to our take on where we are, where we've been, and what we're planning for the future as it relates to our discretionary portfolios. I want to remind everybody as well that, as you know, from time to time, we not only do these quarterly market-related topics for a webinar, we also try to do some financial planning topics. Coming up on September 24th, at 4 p.m. If you care to join us live, we will also record it. We're doing a college planning webinar topic, and welcome your participation. If you have children, grandchildren that may be facing that time, this could be a useful resource for you. So, Brian, I think we're a couple of slides. We want to jump ahead here, but I will turn things over to you at this point and mentioned that we had done a different recording previously where we had the opportunity for questions and so forth. So I may, at the very end, jump in with something that might relate to the kind of things people might have asked. Okay. With that, Brian, take it away.
Thanks, Chris. We're going to do a quick review, as we typically do over year to date, what's happened so far this year. Like Chris said, we're going to talk about opportunities and risks. As people might know, I always emphasize that our asset allocation is really a two-step process. One, you identify the opportunities and the risks, and two, you pick assets that will buffer the risks and try to take advantage of the opportunities. So it leads into the portfolio construction, which we're going to talk about there, in items 4 and 5, and then finally I'm just going to have one slide to wrap it all up. And like Chris said, we did this live. Now we're recording it, and I think he's going to try to repeat some of the questions that came out of the live version. So what's happened so far this year? Well, it's been a pretty good year, and it's been a pretty good last year and 9 months, basically since the fourth quarter of 2022. The stock market has been doing very well, and here's a chart of our major ETF mutual fund strategies showing annualized returns over the 1, 3, and 5 year periods. And I gotta say, I'm fairly happy with where we are right now. And I'm going to break this down by calendar year too, and you'll see that say for 1 year since we've been tracking this data, things have been pretty good. Here are some of the major averages going from the All Country World Index, which includes the United States and countries around the world, which we think of as our main equity benchmark because we do invest internationally. And then the S&P 500, the Aggregate Bond Index, and a money market fund. So you can see that really good all the way around, with the exception of the Aggregate Bond Index, which is still negative, almost 3% over 3 years. It's going to take some time for it to catch up as interest rates had jumped significantly following the pandemic. That the inflation fueled rise in yields that we saw. And this is what I've mentioned earlier by calendar year. You can see every strategy has had a positive year in all the way through year to date, with the exception of 2022. 2022 was the dark spot. That I think what this illustrates is more years out of not, the market's going to do fairly well, and what we really want to do is find the right amount of volatility where you can be comfortable and outperform. I think 2022 especially highlights this, because this is an order of least risky to most risky strategies that we have. With the all fixed income being the least risky, you can see that it lost the least amount of money in 2022. So that our ideal goal is to find what the portfolio where you can ride out the events of 2022 without issue and capture that return that we see in 2023, which almost mirrored the downside plus some in 2022. Similar to the index returns, great all around except for 2022, with the exception of the U.S. Aggregate Bond Index. We saw In previous slides, that the annualized 3-year return was down almost 3%. We could see that it had a bad 2021 and a bad 2022. That was once in a once in a few generations event that happened where we had 2 negative years for the aggregate bond index. So, we've recovered since then. 2023 was a very good year for bonds, and year to date, so far we're positive. I wouldn't say it's a very, very good year, but at least we're positive. So what are some of the opportunities that we're seeing in the market? Looks like that S on this program is looking a little funky, so I apologize for that. I think that is a program specific issue that we're working with here. So, inflation was the past. We were able to take advantage of overweighting some of the NASDAQ 100 names in 2023, actually late 2022 into 2023. And the reason why we did that is because we expected to do very, very well in a falling interest rate, but also falling inflation environment. So we have seen inflation top out in June of 2022 when the market was confident that was going to happen. The NASDAQ 100 names started to rip. The reason why I point this out is that opportunity is in the past. The inflation is really coming down to target. It's a little bit lower than is represented here because we had a new reading this week. But the main story is, that peak is now settling in on where the Federal Reserve wants it to be. And I think, generally speaking, this opportunity that has been playing out for a while now is likely going to not be there, or at least not be there in as a robust way as it has been in the past. We're in a great situation from a demographic standpoint, and I think this helps explain a lot that's going on in the economy. The general consensus was that the rapid rise in short-term interest rates that we saw was going to be very detrimental to the economy, and it has been. We had a very, very robust economy, and now it's settling down closer towards the long-term trend. But the expectation was a recession from that was the consensus expectation. And one of the reasons why I don't think we've seen that is if you look under the baby boomer generation there, the amount of wealth in 2023 is staggering. It's 76.2 trillion, richest generation ever by a long shot. And now they're benefiting from 5% interest rates, higher equity home values, higher stock prices. That wealth effect has caused a general burst in services activity, whether it be through trips and transportation and things like that, but also I think has helped push up shelter costs. The millennial generation to the right is also growing. 32 years old is the most populous age in the United States, and those folks are aging into home ownership. The baby boomers are often their parents, so you can see how that relationship and wealth could spur further activity. Now, on the next slide, I want to emphasize that millennials are rapidly and increasingly starting households. So that's what this chart is showing. And I did this data, I found this chart from the Joint Center for Housing Studies of Harvard University, but I looked at the raw data myself. And this is the fastest growth in headship rates. Headship just means head of household, since that I've calculated since ever. And I went back to 1960. So we're hitting a boom in economic activity for the largest generation, which is the millennials. The second largest generation is benefiting from a very, very large wealth effect that's going on. And they're often probably related familially. So there's a benefit there as well. And I think that's part of the reason why you've seen new housing, for example, continue to do well despite this high rate environment. Now, there's a lot of tailwinds that come with new headship rates, right? Not only do you see shelter go up and economic activity there, but everything related to that. So we aren't seeing a ton of home buying right now, but I think that could change, and that could be a tailwind in the future, and that could also be a tailwind for things like furniture, which haven't done well, and all the things associated that go on with moving and starting a new household. This is all trickling into earnings, right? I think we all know about the new technological advances that we're seeing, whether it be artificial intelligence or GLP-1s, but also this demographic tailwind. I mean, we've seen I mentioned housing earlier. We've seen home builders, for example, do fantastically well. Earnings are expected to grow at over 10% a year for the next couple of years. And you might have heard me say that earnings and interest rates are the most important thing by a mile when it comes to evaluating stocks. And this is one part. This is the numerator in that equation, and that the numerator is looking very robust, which is why we've seen a lot of growth in the stock market. At the same time, the Fed funds is expected to come down. The widely anticipated and expected first cut is likely going to come in September of this year, with anywhere between two and three cuts for the rest of the year. The amount of cuts that happens in the near future, I don't think is necessarily that important. But what is important is the direction. It's likely going to come down, short-term rates, and we want to be in a position to be in assets that will take advantage of the change in short-term rates. This is from the FOMC's summary of economic projections, and this is what they think the Fed funds is going to be for the next couple of years. This isn't necessarily my opinions or bank's opinions. This is the people actually setting policy's opinion, and they expect it to be around 3% between 2.5 percentage points in cuts over the next 2 years. That should be a tailwind, all things equal. It's important to note that things are almost never equal. Oftentimes when they're cutting for a reason. That's because the economy is slowing down. So that's something to keep in mind. Now, small caps are reacting to rate expectations. This is a relatively older chart of the Russell 2000 with the Fed funds rate. As you can see, as Fed funds went up, the Russell 2000 went down. And as it started to plateau, it started to recover a little bit. And now that rates are expected to be cut, we've seen just a huge jump in small caps in recent weeks. So this is all to say that small cap stocks are expected to benefit from changes in short-term rates. And of course, that makes sense. These tend to be more indebted companies. They're far more likely to have floating rate debt because they're typically, financed through bank loans. So this should be a major tailwind for small cap companies, and the change that we've seen recently should not be a surprise based on what we're seeing and how these companies operate. We mentioned last quarter, and we've seen it play out in the market, that we expect this surge in electricity demand to benefit utilities. The surge in electricity demand is largely caused by the enormous amount of energy needed to support artificial intelligence databases. So these things are being built, all over the country, but primarily in the Virginia, Carolinas area. And I think this is something that we should all pay attention to. This real jump in electricity demand may make something that is typically a non-growing asset or something that grows between 2 and 3% a year, a 10% grower. And it's not priced as if utilities aren't priced as if they're going to grow by 10%. They're priced as if they're going to continue to grow at 2 to 3%. So that's something that we are interested in right now, and we look at as an opportunity. As boring as utilities might seem, we want to go where we think we can make a nice risk-adjusted return. So we wouldn't be doing our job if we were just talked about the opportunities, right? We need to address the risks that are out there. There are always risks. I think the people often say, well, why don't we sit on the sidelines until we get a little bit more certain about the future? The future is almost never certain. In fact, if things do seem to be going really, really well, prices likely are going to get out of control, and then the valuation might be the risk, right? So there's always risks, and that's why we talked about at the beginning. Our goal as a firm, and most financial advisors' goal should be to find the strategy that fits your risk tolerance, so you can get through the risks responsibly. And part of our job is to try to make that experience a little smoother for you, so you can benefit, so you can withstand the tough times and take advantage of the good times. So the biggest risk that I think is going on right now is this rise in the unemployment rate. We've seen a little bit of an increase in continuing insurance claims. The labor force has grown. You will hear people say that the market is creating some slack, but it's not necessarily a problem yet. The thing that I'm concerned about is these items tend to trend. So you won't see typically you won't see the unemployment rate, if it's coming down, abruptly go up, and you won't see a rate that's trending up abruptly go down. That's not typically how it happens. These things tend to trend. So we were at a low of 3.4% on the unemployment rate, and that was admittedly a very, very low rate. Wages were too high. Inflation was a problem. The Federal Reserve stepped in aggressively. We've seen, a significant rise in the unemployment rate since then. And my concern is that this is going to continue to trend, and the Federal Reserve is not taking it as seriously as maybe they should. So that is a real risk that this could continue to be a problem, and lead to the recession that we've so far skirted. Concentration risk. If you've listened to me at all over the last year and a half, you might know that I have not been concerned about this. And lately, I am becoming more and more concerned about this. The facts have changed, so I'm going to change with it. And here's the reality: 37% of the S&P 500 is made up of the top 10 stocks. Their earnings contribution is only 27%. So that does not make sense on the face of it, right? And that's something that we might want to consider, diversifying from. Now, I understand why there is this concentration and why those stocks, are leading their earnings, and that's because that's where all the growth is expected to come from. But there is this cyclical nature of new technologies that has me a little bit concerned. This is from a consulting company called Gartner. They developed something that they call a Gartner hype cycle. And there's little academic research behind the robustness of this model, but I will tell you that it seems to be true just from my observations, and I'm going to show you, a couple examples. So basically, what happens is people get excited about a new technology, whether it be AI or GLP-1s, or cryptocurrency, or whatever the new thing might be. And stock prices and excitement peak. They skyrocket and then peak, and then there's a significant downturn from there, and they call that the trough of the disillusionment. Now, these technologies are often still good technologies, right? They haven't had the time to develop into the hype that it had at the beginning. And let's look at some examples. Here is Cisco Systems from the dot-com crisis, or before the dot-com crisis, to today. So you can see that people got very, very excited about the infrastructure of the internet, as well they should be, right? I mean, I'm recording this through the internet right now. Me and Chris are not in the same room. So a lot of what was predicted in 99, 2000 came to fruition. But there was certainly a trough of disillusionment, and this stock has not even made it back to the returns that it saw in the early 1999, 2000s. And that's just because it got too expensive. The hype was too big. People got too excited, and this could very well happen. Now, we have a concentrated market. One of the biggest 3 stocks in the world on any given day is a cyclical company that's focusing on a new technology that routinely has had very, very large drawdowns. So this is why I'm a little bit concerned about the concentration risk. Here's another example. This one only goes through 2006, because Amazon has made its new high plus some. But you can see that the same story played out, right? We were going to have an e-commerce revolution in 1999, 2000. And we have had an e-commerce revolution. I can order anything I want on Amazon, and it'll be here today or tomorrow. But it took 24 years to come to fruition, and that's what happened to the stock price, right? This mirrors the hype cycle, in an interesting way. And I don't want to be caught flat-footed if we see the same thing through these technology stocks. And what's interesting is the customers of NVIDIA. I'll just say it. The customers of NVIDIA are your hyperscalers. So what does that hyperscaler mean? It means anybody with a cloud computing platform, whether it be Alphabet, Amazon, Microsoft, those big players, Oracle. They're telling you, Meta, they're telling you, earnings call after earnings call, that they're over investing in this technology. So what does that mean? Well, it means they're not going to have to invest as much in the future. They're over investing today. So they're almost telling you we're at the beginning, we're somewhere on that hype cycle at the beginning, and they're expecting, they're forecasting disillusionment. So I think it's interesting that the customers are actually telling you this, and I think we need to listen. So current positioning. So as you can imagine, we're going to make sure that we are very diversified if we want to avoid market concentration. So here is the 50-50 allocation as it stands today. And I'm going to show you what we're going to change, and then I'm going to show you how that's going to change in the portfolio. Since we think that a big risk in the market is concentration, we're going to make sure we're more diversified, and that's what I'm showing in that bottom right. We're going to be in small companies more than the market, because the S&P 500 is all large cap companies. It's all U.S. domiciled companies. We're going small, and we have some international. When it comes to that stock that says 55%, we are not overweight stock. 5% of that 55% is that option-based buffer ETF that I mentioned at the top of the slides. We are even in our allocation to stock. We are underweight beta, which means that we're taking a little bit less risk in the overall market. And part of the reason that we are underweight beta is because we are overweight in utilities, like I mentioned. Now, finally, that cash balance of 9.5%, you do not have a cash balance of 9.5%. Our largest fixed income position emphasizes very short-term fixed income, and the program is recognizing it as cash. Why are we doing very short-term fixed income? Because currently, until the Federal Reserve cuts rates rather aggressively, that's where we are making more return than we would otherwise with far less interest rate risk. So that has been a very good strategy for us, and that's part of the reason why our fixed income portfolio has done significantly better than, the aggregate bond index, for example. So again, here, this is just showing our fixed income exposure. You can see that cash balance that I mentioned is unsurprisingly about twice as high, and that's because this is only looking at that fixed income portion. If you were to add in the equity portion, it would cut it in half. So that's the same story there with the cash. Now, more importantly, the bond credit quality exposure, we are overwhelmingly in high quality credits. You can see that, I highlighted the AAA to A there, but BBB is also considered investment grade. We are over 90% investment grade bonds. And I actually look at that as a bit of an issue, and we'll get into that when we talk about the forward positioning. So some other key stats. I mentioned before that the reason why we're in cash is because we're getting a nice yield. So you can see that the yield to maturity on the portfolio is 5.6%. I consider that very, very good, especially when you look at the 10-year at 4%. And what has this done for us? Well, we have returned better than our benchmark by taking less risk. And those are those two other circles that I have highlighted there. And I think part of the reason why we've been able to do this is because of this gift that we've been given over the last 2 years, where we have not had to take any interest rate risk, and we've been able to get paid rather handsomely. And that's really benefited us against our benchmark, which is a very tough benchmark to beat, while taking less risk. Now, forward positioning, what are we going to do differently? Well, we are going to extend duration a little bit. Where I said that we were very, very heavy in cash and cash-like instruments, we're going to take that down some. Not a lot, just some. So you can see that going from 9.5 on the left to, on the right, the new portfolio, which is going to be around 8%. And that's going to filter into your bond portfolio, where you see it's near 35% on the left, and it's going to be over 36% on the right. And that's a pretty minor change. This is what I consider extending duration responsibly. We want to benefit from falling rates. So as interest rates fall, bonds do, the prices go up. But we don't want to get whipsawed if there's some kind of surprise. So what I call is extending duration responsibly, and that's the goal here, slowly but surely. How are we going to do this? What are we investing in? Well, I mentioned prior that I think it's a bit of a problem that we don't have any credit exposure, or we have minimal credit exposure. And why is that? Well, you get paid more on credit. And the reason why we don't have any credit exposure is because low-grade credits are very, very expensive right now, historically expensive. So we want to add this fund. The reason why we want to add this fund is because they have a good track record of extending into low credit opportunities opportunistically. Right now, they share my philosophy that it's not worth it, and they're allocated fairly responsibly, which is good. That's what I want them to do. When the opportunity is not there, I don't want them to do something irrational. But I also, we only make changes quarterly, and I think that it's very possible that attractive opportunities in the credit space could become available within the quarter. And I think that these folks have had a good track record of showing that they can extend credit at any time, whenever they see opportunity. And why do I think that? Well, here's the returns that they've seen against their category. So this is a total return category. This wouldn't be the aggregate bond category. This category is much harder to beat than the standard aggregate bond index. And you can see that they're in the top quartile of doing this over 3 years. And over 5 and 10 years, they're one of the best funds, right? They're in the top decile. So they have a very good track record of doing it. Personally, I've met with them a few times, once in New York, twice in Boston. And they have instilled, confidence in me that they know what they're doing, and can do this responsibly. Now, we're going to be in constant communication with them. So if they alter their portfolio significantly and it changes what I want to do from our asset allocation, we will be aligned on that. So what are the key takeaways? The good times keep rolling in Q2 of 2024, and we're a month into Q3 of 2024, and things have been good as well. And our overweights to small cap and utilities have proven exceptionally good moves in the last few months. So I'm happy with all of that. Now, what are we seeing in the opportunities? Rate sensitivity, demographics, a lot of wealth, and I think the demographics and wealth. I think that's leading to good earnings. At a technological innovations to that, adding to earnings. So we want to be in rate sensitive assets. Utilities tend to be rate sensitive assets. Small cap tends to be rate sensitive assets, like we showed in that chart where I showed Fed funds in small cap moving. So that's where we are. Now, what are the risks? We have an increase in unemployment. We have concentration risk. We have cyclicality risk. So cyclicality and concentration are, kind of one and the same in this idea, right? Because I'm worried about some of the largest, more concentrated stocks and indexes, selling off in a cyclical moment. And what are we doing to address that? Well, we're not taking a lot of risk in the fixed income area. We're not taking a lot of risk in the stock area. We're actually taking less than our stated target risk when you think about the beta being under 1, and we are diversified far more than the market, whether it be through small caps, utilities, or the low volatility fund that we have. Our current positioning: we're short duration. We're at target equity. We have a risk position in small cap and utilities, just kind of repeating what I just said there. And what are we going to do? We're going to slowly increase duration, and we're going to add a new total return allocation to try to take advantage of credit opportunities that don't exist today, but hopefully may exist tomorrow. Any questions?
Well, Brian, I mean, I appreciate the content in that. I think that this has given us a chance to get really clear to our clientele and those who are paying attention to the podcast, or the webinar here, that we are diversifying. You've already taken steps when it came to previous quarters to introduce small cap and utility exposure, this buffered ETF to help mitigate some of the volatility risk, but still take advantage of some of the opportunities that may exist. And, while we're still retaining large cap names that have performed well, but trying to take advantage of diversifying away from being, not just those where the market is, created a lot of enthusiasm. And, this notion of gradually extending duration, certainly something, that's been on the market's mind, people have been thinking about, and I think you've really navigated this deftly with the idea of trying to take advantage of those higher yields that we were getting on the short end, but recognizing that as the moment may be changing, we want to gradually make some adjustments in the way we present that, and perhaps even with the opportunity for the credit risk with this new position you just talked about. One of the things that I think is on investors' minds is the question of whether or not the market is overextended, and is there a worry? Should we be worried about um, uh, declines, volatility that naturally is part of the way the market moves? So maybe I think some of the things you're doing in the portfolio speak to that already, but do you want to just talk a little bit about that concern that sometimes I hear from clientele about um, the concern whether the market is overextended and potential for volatility risk?
There's always potential for volatility risk. Let's make that clear. What I think people are really asking, are we going to have some kind of dramatic drop off when they're withdrawing money as retirees? And I think first and foremost, if you're really concerned about that, you're likely probably taking too much risk.
Yeah.
And I'll just start by saying that. Now, when it comes to the portfolio, we are taking less risk than the overall market. We are more diversified than the overall market. So what do I mean by that? Well, like I mentioned, our beta is lower than 1, which means that historically speaking, at least on a backwards looking basis, our portfolio would have less volatility experience than the overall market. Going forward, I think that makes sense since we're exposed elsewhere, that we would have less volatility. Secondly, I think the market's expensive, but I think a lot of the expense is coming from that top decile of stocks, right, that we talked about, and we're diversifying away from that. If you look at the other 490 stocks, they're not historically expensive. In some places, I think they're historically cheap. Like I mentioned there with I think utilities are misunderstood. I think the growth in that sector is going to be far more robust than it is historically, and it'll take time for people to figure that out, but it'll play out like that. Would be my expectation. And finally, the market's maybe expensive compared to what I would like to see it be at. I would love to see it a few percentage points lower, but I think I'll just be frank with my calculations here. I think that you should expect about an 8% real return on average at the current prices. So of course, that's lower than the average that we've seen over the last few years. In the last few, we're looking at somewhere around 14% in the last decade. It's been very high. The 100-year average is around 10%. But I don't think 8% means that you are so extended that we're in for a dramatic crash or anything like that.
Well, and I think
Especially
as you're talking about, there's opportunities in different places in the market, and there's different ways to access those opportunities. And let's not think about the market purely in one category, as there's different aspects of the market, and we'll do what we can to try to allocate actively as we do to identify opportunities and
yeah.
narrow
Well,
those risks.
I'll give you a couple more examples. I mean, small cap's historically cheap against large cap. It's just is by any measure that you want to look at, it's historically cheap. So if you're worried about valuation, keep in mind that you're diversified in the small cap. International has been historically cheap for a while now against U.S. large cap stocks, but it's if you're worried about valuation, we have a place there as well. So the key, if you're worried about some overvaluation, minor overvaluation, I would say, is diversification. And if it gets really out of control, then there's other levers to pull to try to make that experience a little easier.
Remember that we're active in what we do, and then secondly, if it's something you're particularly concerned about, as you said, maybe it's a good time to be re-examining your allocation preferences, and particularly if you think the market's elevated, certainly a good time to do some downsizing of the equity exposure. We can't close out without talking about what everyone asks about this year, and that's elections. And we've talked about it quite a bit. I know probably feels tired to you, Brian, and because you've talked about it quite a bit. But at the same time, I think it's on people's minds more and more so as we get closer to the election. We've had some changes in the dynamics with um, Biden dropping out of the race and Vice President Harris being the likely Democrat nominee. So with that, I don't know. Is there anything that you can share with our clientele about uh, how they should be thinking about the market implications as we look ahead to an election year coming rapidly?
Yeah, so a few points. Historically, elections have not mattered for the stock market. It's gets a lot of airplay, and that's why I always kind of laugh and maybe roll my eyes a little bit when we have to talk about politics because it's far less of a factor than people give it credit for. Secondly, this the stock market does well under Republican presidents. It does well under Democratic presidents. It just does well typically all the time. I did an analysis a while back, and it showed that except for George W. Bush, and maybe a little bit under Nixon, the stock market's done well under every uh, presidential administration going back to leaving the gold standard. So, from that just objective point of view, the stock market's done well, right? It's done well under Trump. It did well under Obama. It did well under Biden. My guess is it's probably going to do well over the next 4 to 8 years, whoever's president. So, that's being said about the president. Now, when it comes to Congress, that matters too, right? Congress could make it very difficult for the president to get any of its agenda done, particularly on fiscal policy. And that would be good for the market, right? And if we had a split government, then that's what would happen. If we had a consensus government, well, I think both parties have inflationary policies, generally speaking, right? The Republicans would probably like to cut taxes. The Democrats would probably like to raise taxes and raise spending. And I think they're both interested in additional tariffs. So, if I'm looking at it from that perspective, it would be inflationary either way. I think they're actually more in line than you would imagine on economic policy. And we've seen that through many presidential administrations as well. I mean, we haven't had a balanced budget since the Clinton administration. George W. Bush spent more money, Obama spent more money, Trump spent more money, Biden spent more money. So there's a track record of consistency there as well. So, when you step back and try to look at it objectively, I think it's a lot about nothing.
So, and I think when it comes to some of these thoughts that people have when it comes to policy or regulatory implications, there may be opportunities to make adjustments once we know the outcome. I think generally markets like the idea of divided government so that there's not big swings in policy. But so we'll see how things play out. There's still time for us to, as we get closer, to really have greater insight as to what that may end up being.
Yeah, let me tack on one more point there. I prefer to react to actual policy.
Yeah.
Speculative, reacting to speculation is typically not great. I mean, I'll give you an example, right? Let's just say simply that there's a 33% chance that let's say there's a 66% chance that there's not divided government and a 33% chance that there is divided government. Well, I can't really predict, even if I were to guess with the Republicans or the Democrats, what policies would get through a non-divided government, right? Through a consensus government, and I know nothing will happen through a divided government. So it's like, why speculate on it if you don't even know what policies are actually going to come through and when? I think the only one that I would consider you can kind of guess what would happen is the Tax and Jobs Act. We could,
Yeah.
if we could pretty much guarantee that that'll get extended under a Republican government and likely be altered under a Democratic government. But other than that, and that's tax law that's already in the books, right? So that's reacting to tax law that already exists, that policy that already exists, not speculating on future policy.
I think too, oftentimes when investors think about, what an outcome may be, it doesn't always work the way they expect. When we talked about this once before, the idea of, you might expect have had expectations for one party or the other to impact energy by their regulatory behavior, and sometimes that's not doesn't create the earnings expectations you might anticipate, and the way markets might move. So
I think the rhetoric around those things are often different than the reality too. I mean, if you look at, I mean, we've had how many conversations we had with folks that were worried about oil and gas issues with a Democratic president, and if you look at rig counts, it's done nothing but go from the bottom left to the northeast,
higher than never,
and
right?
despite being a Democratic government. So, sometimes it's this shouldn't be surprising to anybody, but political rhetoric is not actually the reality on the ground.
So in any case, stay tuned, I guess, is the answer there. And a good point for us to kind of wind down and wrap up. And I guess, big picture, there's changes that we are making within the portfolio to be mindful of changing dynamics in the market and economy. And as we look ahead, if you find that you're uncomfortable, now's a great time to reach out to us, and we are happy to review with you how you're positioned and whether there's changes that could be entertained. And oftentimes, it's very possible for us to make some incremental changes to suit your comforts without doing anything drastic, but in a way that you'll feel more at ease. So, if there's anything that you have as a concern, don't hesitate to reach out. But big picture, um, as Brian has been pointing out throughout the presentation, there's a lot of opportunities and there are risks, and we're trying to be mindful of both as to how we navigate the portfolios on your behalf. Till next time, we're available if you need us. Reach out.